Good morning, everybody. Kia ora. It's lovely to have everyone joining us this morning on FSC Connect in the middle of August. It's been a pretty interesting start to the year, and for those of you who've joined us for some of our previous events, we were lucky enough to have the CEO of the Financial Markets Authority, Samantha Barris, earlier this week. And of course, we're all staring down the current Omicron wave, and of course, the very devastating war in Ukraine. And so, in many ways, the conversation today, which we actually planned out 6 weeks ago, as Komal and David were saying several weeks ago, it's actually a very prescient and relevant discussion today. So we're delighted today to be exploring the topic of ESG and the whole world of sustainability with a very relevant focus. Let me introduce our two speakers today who are going to be exploring some of the what is ESG, why is it important and relevant for trustees, what are some of the dilemmas that investment committees and consumers need to make, and what are some of the impacts given the Russia-Ukraine conflict as regards investing and some of the sanctions that are going through. Our two speakers are fantastic, and delighted to welcome Komal Jalan, who's the Principal of Sustainable Investment at Mercer Investment Management. She is the principal of that business. She's based in Sydney, and she leads the sustainable investment function for the whole Pacific region. There's a whole lot more which is in Kamal's bio, and David and Komal will be having a conversation about all things ESG. And of course, our very own David Ireland is with us today. He is the one of the co-chairs of the Workplace Savings Training group. He's also a partner at Dentons Kensington Swan, and has been a really strong supporter of the whole sector in New Zealand for a number of years. And between David and Komal, they're going to take us on this a ride of ESG. And with that, let me welcome them. Let me welcome you who are watching, and let me hand it over to you, David. Thank you.
Thanks, Richard. Morena, everybody. And thanks for inviting us along to talk about this session. The content has actually changed a bit over the last few weeks, as Richard has indicated. But what we're going to go through, I will commence just providing a little bit of a legal framework parameters for how we go about approaching ESG from my legal perspective, as you'd expect. So sort of a little bit of the warm-up act before we get into the meat of ESG, where we are very fortunate to have the expertise of Komal to come in and walk us through that. So just like a little, probably like 10-minute just starter around what are the legal parameters to think about as a trustee of a workplace savings scheme if I am either embarking upon an ESG journey, or if I'm looking to tweak my approach to ESG and how I'm going about it. So first up, probably as a trust law duty, one of your fundamentals as a trustee of a scheme is to be investing prudently, right? That used to be locked into the old Superannuation Schemes Act as to the clearly pretty tight parameters as to what you need to do. It's a bit broader now under the new Trusts Act, and the regime works. A decade or so ago, it was a genuinely an open question as to, is it prudent to restrict your investment universe to have an SRI filter? And I'll confess to being one of the skeptics in this space of looking at, well, how can it make sense as a trustee to be limiting the things you can invest in? How is that going to be a discharge of your responsibilities as a prudent trustee? As with many things in life, I've been proven wrong by the passage of time and how that works. And you say, well, actually, ESG, SRI considerations are absolutely mainstream. Almost the dial has completely flipped. to now say, well, if you're not thinking about SRI, ESG considerations, are you actually being prudent? Is that appropriate? Not saying that you have to, but actually this is a genuine consideration for all of us. Similar almost to the journey we went through with passive investment. This is going back to the 90s when that first started coming through. I remember working through on seeking binding tax rulings for a passive investment strategy for a superannuation scheme, and went through all sorts of tribulations to say, well, is it prudent to deny yourself the ability of active choice and to respond? Now the argument sort of becomes, well, there's very strong arguments from some sectors saying actually passive is the only logical thing, and yes, you should be doing that, and questioning whether active is an appropriate strategy to adopt. Not making a call either way on those two options, but I see actually SRI, ESG in a very similar camp, although I feel that the dial has probably flipped more towards thinking as a trustee, your responsibility must involve you thinking about ESG. Does it make sense in the context of your scheme? Komal will obviously be going through a bit more of that, or teasing out that discussion in a few minutes. The next thing, I guess, as a trustee is then looking at your trust deed. Of course, as a trustee, you must follow your structure, the rules that are set out in your trust deed if you're going to embark upon a change in your investment strategy, and just making sure that you are following the correct process. It would be a very unusual trust deed that said you could not embark upon an SRI strategy. It's more a case of actually following the process. So what are the powers in the trust deed before we look at fiddling with our investment strategy, as indeed with any other change you might make in the investment and managing the investments of your scheme. If we then look at the Financial Markets Conduct Act of the broader, I guess, the statutory duties that you will need to discharge when thinking about ESG and your approach to it. As trustees of a workplace savings scheme, and indeed any retail scheme that is operating in New Zealand at present, you do have a statutory duty to act in the best interest of your scheme participants. You must also, in exercising any power of investment, you need to exercise the care, diligence and skill that a prudent person of business would exercise in the same circumstances, with an extra layer if you are a professional trustee. So the question to ask is actually, is ESG, or your approach to ESG, actually in the best interests of your members and a prudent thing for you to do? You might want to think about, particularly in the workplace savings environment, even canvassing your members or making sure, well, actually, does this make sense in the context of our particular scheme, as a little bit of an overlay to a just straight commercial investment consideration, recognising that for a workplace savings scheme, the employees of the organisation that are members of the scheme probably don't have any other option. They are stuck with your scheme, as opposed to a retail scheme where if members don't like the investment strategy you're adopting, they are usually able to vote with their feet and choose another provider that they let's say whose investment rationale resonates with them more. So always think about canvassing. You don't absolutely need to, but just think about, how do we discharge or demonstrate that we're acting in the best interests of our members with the investment strategy that we do adopt, and document your rationale. Actually record in your trustee minute your decisions. Why are we going down this route at a high level, not the nitty gritty, just actually, yep, we've considered, we've assessed, we think this is in the best interests of our members, just to support yourself there. Sticking on the statutory duties line, of course, we do have some statutory filters in play, i.e. you should not be investing to have exposure to cluster munitions, chemical weapons, etc. Sadly, something that is very poignant at this point in time. We'll talk a little bit about the Russian overlay a little bit later in the session, but that's just another extra filter that will now come into play. If you are a KiwiSaver scheme, you've got an added statutory obligation to disclose your approach to SRI. What you've got in a KiwiSaver scheme is a binary disclosure decision to make. If you take SRI considerations into account, then you must disclose a statement to that effect. And then if you don't, then obviously your statement goes to the other effect. That is prescribed wording, can be a little bit challenging to pick yes or no. At the early days of KiwiSaver, most schemes, certainly that we were involved in, would have been ticking no because they did not flow through all of the criteria for the SRI considerations. Again, that has flipped now to increasing numbers of KiwiSaver schemes will be disclosing, yes, we do take SRI considerations into account, and then flow that through all of their documentation, including their statement of investment policy and objectives. And that becomes the real acid test as to whether you are faking it or greenwashing things when you say, yep, I take SRI considerations into account. The proof of that is not only in your actions, but actually in your statement of investment policy and objectives. Has that been coherently recorded there? If we're changing our ESG approach, make sure that that flows through to reflecting that in your SIPO. That becomes the piece for your members to look at, just to unpick, to say, is this actually consistent with what I am seeing or with what the administrators, my scheme trustees are telling me? Of course, you've also got with, from the regulatory side, looking at your full set of disclosures that you've got up there, not just your PDS, but look at your other material information that is loaded up on Disclose. Has that properly recorded your approach to ESG investing and the mechanics, the thinking that you have in mind? You've got a lot more freedom. It's probably one of the only areas where you do have a bit of freedom to express yourselves in the regulatory environment in terms of a coherent statement as to your approach to responsible investing, ESG considerations, given the limitations that we have in a PDS to fully disclose what you would like to say. So you make use of that OMI to actually explain your story and support any discussion assertions you are making around ESG. That's probably it from me for now from that legal framework side of things, just as a little bit of a scene setter to what you need to look at from that legal perspective. I'd now like to just bring Komal into the conversation and perhaps perhaps tell us a little bit about yourself, Komal, and about your ESG journey.
Morning, David. Thank you. Yes, my ESG journey, it's been over a decade. So really started with equities and analyzing corporate governance at listed companies, and then evolved to large multi-asset diversified asset owner funds who pretty much were starting ESG from a blank sheet. And so that really gave me the opportunity to build sustainable investing within those funds quite foundationally and define its purpose. You know, what we're going to talk today, really, why do we do this and how we do this? So very fulfilling.
Cool. Thanks for that. Okay, and let's start rolling the sleeves up and getting into more of a discussion about ESG and what are we actually talking about. So what does it actually mean for you, and why do you think trustees of workplace savings schemes should really care about it?
Yeah, really pertinent. Well, it can be, as you mentioned, it can be a bit soul-searching to think about the role of sustainability professionals in a time of war and pandemic. But look, simplistically, my personal thinking on ESG is really a two-way understanding of impact. And this is really, how does environmental, social, and governance factors impact my investments? And how do my investment in turn impact the environmental, social, and governance factors? So for instance, climate can impact my investments, but my investments can also impact climate. So, but, you know, ESG can mean different things to different people. So let me start by just giving an overview of, you know, what is ESG? We'll move on to talking about why we, you know, the question, why we should care about ESG. And then we'll move on to how do we do ESG. And as you can see on this one, you know, ESG, and when we unpack the acronym, it is in fact a list of broad and diverse range of factors. So it is not a definitive list. And so the selection of these factors, the prioritization, the materiality of these factors could range from an individual, from investors to companies. And if we move on to my next slide, and we would really want to unpack the terminology here. ESG, in meaning different things to different people, can have many different labels, as you see on this slide. So there is no one term or approach that can describe this. Really depending on the emphasis of what investors want to achieve or what is their motivation for doing ESG, different labels are used, and we're all very familiar with these labels. We could call it ESG investing or socially responsible investing or impact investing or green investing and responsible investing and value-based investing. But if you really see the three primary motivations for doing ESG, can be seen as ESG integration. And this is on the right-hand side here. So ESG integration is, I believe that incorporating ESG may improve my investment returns. So it's really focused that it can improve potentially the portfolio's long-term investment results. The second motivation, and ESG can be a really powerful tool for investors who want to align their financial decisions with their personal values. And this can be achieved through, say, the use of negative screens. You may be able to identify companies or certain areas of activities that you do not want exposure to. And so that is about incorporating personal values. That could be a motivation. And the third one, which is to the bottom here, it's about, the desire to make a positive impact through one's investments. And this allows investors to really merge the financial benefits and the financial gains, along with ensuring there is good, measurable progress in any one or more of the environmental, social, or governance areas. So we bring together these three key motivations. They are definitely not mutually exclusive. An investor could deploy one or a combination of more than these approaches, or sometimes all three of them. So, but depending on the emphasis is what, is the label that many investors would use. So if we move on to just see this in practice, what does this mean, for instance, for Mercer, and how does Mercer unpacks this? The label that we use is sustainable investing. And it's a comprehensive framework that brings together four key approaches. So we talk about integration. So integration is really understanding that ESG and the consideration of ESG factors lead to better risk-adjusted returns over a longer period of time. They give us a broader perspective of risk. They help us identify new investment opportunities. And so ESG integration is really important. We also believe stewardship, or acting as active owners and not just investors of assets that are entrusted to us, is absolutely important to realize those gains. So, I'll unpack that in one of my other slides, but stewardship is really important. We also talk about investing, and this could be investing, to make that positive impact, investing in ESG themes, investing to make a measurable positive impact in the areas of ESG is really important. And then screening, there are certain activities we want to screen, such as UN Global Compact, to just be aware of those activities and exposures from a portfolio perspective. And then we also want to screen to exclude. And that is when we talk about things like controversial weapons and tobacco. So this is how Mercer, in practice, when we think about what is the motivation for doing ESG, what are our key objectives? We've got a diverse client base, and we bring together these four key approaches. But sustainability is core to our objectives at Mercer. And we really take what we call as the sustainable investment pathway, a really sequential approach to looking at it foundationally, right from beliefs. It's core to our beliefs, policy, process, and making sure we've got that implementation framework that brings together from a portfolio perspective. So then we move on to my next slide, and let's see, why should we do this? Why should we really care about this? And David, you've been absolutely right, in painting that initial or that historical scene that was, ESG was seen as being contradicting to fiduciary responsibility. This assumption was based on the belief that ESG considerations reduced your investment universe, the investable universe. It was more rooted in the practice of negative screening, which defines the theoretically optimal solution that you can arrive at. But the way we understand it now, when we talk about ESG integration, that position or that myth is now largely redundant. There is enough empirical evidence now to say that ESG factors can in fact lead to better long-term risk-adjusted returns. And so trustees may find that ESG investing and their fiduciary duties are neatly aligned. And in fact, David, you mentioned this as well, it would be contrary to their duties to not incorporate ESG principles into their investment decisions. And these decisions could be appointing an investment manager or choosing investment objectives or asset allocation. So when we see on this slide, the 4 points that I've got here for why sustainability matters. So we've got the point around risk-adjusted returns and there being enough empirical evidence, but we're also seeing regulation and, sustainable investment regulation is currently on policymakers and civil society agendas worldwide. And we're increasingly seeing more and more public policy or regulation that's requesting for additional disclosure. So that pace of regulatory intervention is increasing, and that lends itself to why it's important. We also talk about, that increasingly members and millennials and beneficiaries, they're demanding or putting pressure, or they expect their funds and trustees to have a stance on ESG, to have a stance on particular issues. And so not seen to be doing that could be reputationally damaging as well. So it's very much stakeholder driven these days as well. And lastly, when we talk about impact, why should we do this? Because there's this increasing realization that externalities and some of these, ESG could be non-financial or intangible factors, they might not be priced in or captured by the market at the moment. And so when we talk about, the sustainability of returns over a longer period of time and, us trustees' primary duties enacting in their beneficiaries' best interest, then when we take that longer term horizon, and we think about these externalities eventually flowing back, then it becomes an important consideration from that perspective as well. So at Mercer, we have it quite embedded and very well recognized within our sustainable investment policy, the firm belief that it helps grow and preserve investments over the long term. ESG factors can have a material impact on long-term risk and return outcomes. And the second one is really important because ESG allows taking a broader and a longer-term perspective on risk, but also helps us identify new investment opportunities. So really the why. And then on my next slide, we can see what we're all witnessing at the moment, war, pandemic. But when we talk about the top global risks, this is a very live business context in which we're investing our money. This is that macroeconomic situation, in which our investments live and they generate returns. And so on the left-hand side, if we see the top risks from the World Economic Forum Global Risk Perception Survey, then the top 5, are very much those ESG risks. And on the right-hand side, Mercer contributed to a research with World Economic Forum on transformational investing. And we identified these systemic risks that in some ways can all be interconnected, but very relevant for investors and their portfolios. And so the findings of this research were that investors can enjoy good long-term returns by making themselves aware, but also working to manage these in their portfolio context within their investment decision-making. So very much aligned to that objective of, investment performance. Now let's get into, having done the what is ESG, unpacking the labels. And then, we talked about why should we do this, some of the things that have driven the recent rise and the uptake of this. Let's get into it. Should we do it? How do we, unpack this lofty goal, and how do we do this? So my next slide. So ESG integration, and I've mentioned this term ESG integration a few times now. This is not about screening out companies or sectors from investment universe. This is really, when we talk about fundamental analysis and fundamental investing, this is how we understand the risk profile of a company, and once we understand that, how we want to view the company and value the company, what is the expected return, that we can place on that. So for instance, if we look at that two-dimensional approach, just from a risk and return perspective, we can, ABC have 3 stocks that could appear to have exactly the same profile, the risk and return profile, if we plot them on these 2 dimensions. But once we stretch that out to do a 3-dimensional thinking, which sometimes is what ESG is, the risk, return, and the real world impact, then we can see these 3 stocks could look very different to an investor. And that's when, we become aware of the holistic risk profile of a stock, or, what is the attractiveness of a stock when we think about the real world impact of it as well. So it could have the same risk return profile, but from a real world impact, if one has more externalities, really high carbon footprint, that really matters. And that's when ESG aware investors are able to bake in their valuations or premiums and discounts and return expectation. And so it doesn't. So the point here is, when we talk about ESG integration, then it factors those criteria, but it doesn't preclude you from investing in low scoring ESG companies. It is simply that you now understand the risk associated with it better in a more holistic sense, and then you can bake that within your expectations for return. We spend a lot of time at Mercer looking at ESG integration. It is very core to how we bring that justification for, long-term risk-adjusted returns. We're a manager of manager, and we really expect, our investment managers to incorporate this in their security selection, in their portfolio construction. We look at managers and we score our underlying fund managers on a range of criteria, but more importantly, 4 key pillars. When they're generating an idea, idea generation, are they looking at ESG? Then secondly, portfolio construction, when they construct their portfolios, how well does ESG feature in? Then the third one is implementation. How do they really bring this about? Are they engaging with companies? What activities are they doing? And then the fourth one is business management. So, what is, so the manager and the strategy does it, but what is the overall firm level belief in ESG? And then those managers are rated from 1 to 4. And so we spend a lot of rigor in understanding which managers we appoint, which strategies we select when we construct multi-asset diversified portfolios. So that's ESG integration. A lot's just within that topic. When we move on to my next slide, this is a really influential tool, a really important topic within ESG. You know, my initial slide when I shared about us believing in stewardship, this is about acting as owners of assets, not just as investors, really the stewards of capital. And the objective here is, you know, perhaps to improve company practices or policy making or industry standards. And there are different tools through which we can bring this about. So for instance, for listed equities, we've got the shareholder right to vote. And so that's proxy voting. And increasingly, we're seeing the importance of this tool in itself. We're seeing shareholders put proposals at company AGMs, more scrutiny around director elections or executive remuneration. And all these aspects, you know, and investors having a say on these issues do have an impact for bringing about alignment with that long-term consideration of what's important for shareholders, what's important for stakeholders. When we talk about active ownership, we also talk about engagement. And this is really important. This is about having a constructive dialogue, joining hands, investors joining hands, you know, coming together to leverage a larger capital base and make some really strong requests of policymakers, of companies, of sectors to, again, bring about that realization or improved disclosure on ESG. So we could engage with companies directly, corporate engagement. It's very live, does happen. Mercer, really important for us. Collaborative engagement. This is when we come together as industry participants to either, you know, have new guidance for how companies should disclose ESG or even to make submissions to important policies at a government level. And then the last is engaging with your managers, where you're a fund of fund. It's absolutely important to have that monitoring aspect and engagement with your underlying managers. At Mercer, the way we talk about it is, you know, partnering with our engagement leader managers. We've got managers who've got really strong approach to active ownership, really strong approach to ESG. They're day in, day out looking at some of these issues at a company level. And so we want to stay tuned in with them and really understand how they bring it about. But also, as an asset owner and for many trustees, you've got the longer term horizon for some of these things. And it's absolutely important we make it through those engagements. And moving on to my slide, which is the very important topic of climate and net zero. So if we bring all this understanding of what and the how and ESG integration and active ownership, but then if we pick one thematic, which is really important and very topical, say climate change, we were just to think about solving for that thematic. How do we do that? Mercer announced its commitment to net zero last year, you know, net zero by 20, with a 45% reduction by 2030. And so when we think about how do we really unpack this, how do we do this, how do we set those interim milestones, those short, medium, and long-term milestones, how do we systematically approach this? It really rests in two key things, essentially. So the first is what you see at the top. We take a spectrum-based approach to understanding transition risk. And so what we do when we look at that total portfolio, Mercer's got its own proprietary ACT tool, which is the Analytics for Climate Transition tool. And we came up with this tool to be able to profile our investments in three broad categories. So on the left-hand side, you've got the gray assets. So these are the assets which are highly carbon intensive, but have low transition capacity when we, make that forward-looking view. And on the right-hand side, you've got these green solutions, which have low carbon intensity, but also they're very tuned into, should that transition happen quickly, they are the ones to benefit. And then in between, we've got all these assets and exposures with varying carbon intensities, but they've got that commitment that, yes, we're on that journey to decarbonize. And so we want to manage the grays, we want to steward the in-betweens, we want to target increasing exposure to the greens. So the gray, the in-between, and the greens. And the second part for how do we really bring this about really goes back to that initial framework that I shared, the 4 pillars. We want to integrate it because we believe that this matters for long-term returns. We want to be active owners about it. We want to engage with our managers. We want to collaborate. We want to engage with companies. We want to reflect it in our voting. So active ownership. Investment, we want to allocate capital, comes back to the profiling of the greens and screening. So that approach. So you want to screen some very high in carbon intensive sectors to be aware and to be able to manage. And for some of the labeled funds, we could possibly exclude those as well. So it really, comes down to thinking about that framework that's able to tackle thematics, that's able to deal with, a variety of client objectives. And I'm going to pause there.
Thanks, Komal. That's fascinating. Sort of going through all those considerations. We might unpack a couple of those themes in a little bit, but perhaps for now, the elephant in the room, probably the Russian bear in the room, is of course the approach to this sudden change in dynamics from just a few weeks ago to thinking about Russia. When Richard mentioned about today, the sort of the prescience of scheduling today's session, you could not have got it more right in terms of today being the date that the Russia sanction regulations 22 come into effect. I might get into a little bit of detail on that shortly, but I just interested in your initial thoughts, Komal, how might Mercer be changing or looking at, considering any exposure to Russian investments?
Yeah, sure. The atrocities and destruction and human suffering is extremely tragic. Now, we've seen local and global sanctions and many businesses pulling out, driven mainly by, morality and ethics of even doing business in Russia. If I were to take us back to those, what are the motivation and what is that initial Venn diagram for how do we think about this? We can think about this Russian situation both from a values perspective, so, incorporating my personal values, which is the morality of and ethics of doing business. And we can also think about very much from an ESG integration perspective. And, when we think about the investment case, now we know that both in the lead up to and in particular the aftermath of this Russian invasion of Ukraine, we've seen significant falls in the value of Russian assets, now practically to zero at the moment. Russian bonds and stocks and Russian-linked securities, they're essentially illiquid at present. And the stock exchange is closed, central banks sanctioned. We know major benchmarks and indices such as MSCI and FTSE Russell, the MSCI Emerging Market Index, they've now removed Russia. And so is for the bond index. So when we think about the implications from an investment perspective, Russia probably has now become very, very minuscule. So from a valuation perspective, these assets are practically, very, very little. But you might still have some holdings, and those holdings are largely illiquid at the moment. You just cannot trade in and out of those holdings. So very fluid situation. In Australia, we've got the government's advice for super funds to, when market conditions allow, look to exit from the Russian assets. So it's a very fluid situation. But also, when we think about that financial aspect, we're seeing all this removal from indices and what's happening. So,
Yeah, and interesting to have that, yes, the philosophical background, or the direct investment impact. Interesting with our regulations of what they've come through. It's a remarkably swift piece of regs and the detail that has come through in it that are now in effect today. Effectively, the regulations not only impose bans on travel, the movement of ships and aircraft, etc., but for our purposes, the key thing is that the new regs prohibit dealing with certain assets and services, which prevent you from dealing in an asset if it is owned or controlled by a sanctioned person, if you can't hold shares in a sanctioned person, or security arrangements or facilities that are intended to have the effect of making an investment or managing a financial risk issued by a sanctioned person. So the key nub of that is, well, what is a sanctioned person? And it's not just a list of sort of half a dozen state agencies. There's about 4 pages list of individuals. Obviously, at the top of the list is Vladimir Putin, but also a whole list of individuals, plus a whole lot of organizations primarily associated with the Russian armed forces and various divisions of that it flows through. So those become sanctioned persons that you cannot have a dealing in assets issued by them. Of course, the obvious question perhaps for many of the people on this audience, if you have gotten exposure to Russian investments sort of prior to today, what does that mean for you? Obviously, Komal, you've mentioned about, well, these things are largely illiquid and have lost a lot of money. But you'll be perhaps relieved to know that you're not going to be in breach of the new regulations simply by virtue of the fact that you are holding them. So that will not be an offence you can hold. You just can't otherwise deal in. You can't put more money into it. If you've got an obligation owed to you by a sanctioned person in Russia, that can still be paid out to you, but you just can't enter into new obligations. So it's really, it is a forward-looking, but almost like freezing, sort of limiting what you've got at present. It's quite a unprecedented, really, for New Zealand of dealing with this. We've always had statutory filters on not getting exposures to prohibited weapons, etc. But this is quite a major shift. Obviously, still digesting what the implications will be and assessing just what that impact of those regs will be. But I guess an example of, at times the government can move swiftly when eventually you sort of get going. And, this has come through with that detail. One of the things that just interests as you're going through with your discussion was, and you touched on it a bit, but we've seen a shift, I think, from the early days of just filters on, bad stuff to now much more positive screening. I was just wondering if you could perhaps talk a little bit more about that aspect of the slides that you went through, because it is very much my feeling is it's a far more proactive thing now, right? Being ESG Absolutely. Is not just about keeping away from stuff; it's actually doing positive good rather than limiting harm.
And the impact can be far-reaching. So positive screening, as you've rightly picked the label, or talk about impact investing, is really on the rise, and this really links. So there was a time when investors went and they allocated money to green investments and they lost money. They're like, is it just do good and not so much stacking from a value perspective? But increasingly, as we're seeing, with the acknowledgement and policy around more stable environment, around things like climate, it has given that recognition and environment to find opportunities that can make positive impact. So that opportunity set is increasingly expanding for investors. That certainty of going into some of those sectors and looking for opportunities is growing. So you talk about, say, batteries or carbon capture storage or sequestration, hydrogen, all these are relatively new booming assets. And when we talk about, and as we talk about those top risks and issues of importance, those aspects need to be solved for. Sustainable Development Goals. And so these are where capital needs to flow to be able to create that environment in which all investors would be able to enjoy their returns well. And so everybody has a contributing role in that case. And so when we talk about positive screening and deliberately allocating capital to, say, green bonds or sustainability bonds or social and community housing, then that is what we are leading to. We're making good returns, but also we're measuring some very positive environmental, social, and governance progress. So it is now becoming increasingly aligned as being able to do that, as well as, enjoy good returns.
Yeah, thanks, Val. It is exciting times in some ways where you can feel like actually, I guess, more of an onus to make a difference, to be thinking about these things, and actually almost the bar has been raised, I think, in terms of expectations of those charged with governance duties in respect of others' assets. That actually it's not just about the bottom line of the money you're making. It's actually, what are you doing with those funds? Just an interesting shift of where we're going. We'll see where that goes. Another thing that we're seeing a shift on is the marketing of these things and the prevalence of greenwashing. We've had, the FMA has come out with, guidance, commentary around the risk of greenwashing, if you like. I'm just interested in your views of what you are seeing. How big a thing do you think greenwashing actually is versus the reality? And what are any thoughts you have for people trying to remove the marketing spin around greenwashing and what you should be doing?
Yeah, unfortunately, very unfortunate. Greenwashing is on the rise, absolutely in lockstep with the rise of ESG. So, look, there are many contributing factors. At the moment, we do not have standardization. Disclosure is patchy, disclosure from companies, really that bottom-up disclosure. And there's huge demand. We're all aware to these issues. We really want this to happen. We're demanding our trustees and companies and to do this and to give us very quick answers. To be able to do some of these things, if you really think about, like diversity or climate, or these are massive issues. They literally require a cultural shift in many instances for organizations, but also for investors, for how they think about allocating capital. So it can't just happen overnight. And there's this huge demand that's, kind of pushing for quick response and association, which show us that you do it. And and labels are everywhere. So there's sophistication. It's not very sophisticated at the moment, standardization, lack of data. So these are the contributing factors. I think it's really important for people, for investors from companies, when we think about that investment value chain, we're entrusted with people's money, and we allocate that money to managers, and managers could allocate that money to companies, is that we're asking the important questions down that investment value chain. We were able to really look beneath the hood to understand, yes, if you're claiming to do this, how do you actually bring this about? Now, if a fund's calling themselves 100% fossil fuel free, how's that even possible, And whilst it all looks very nice and appealing, but we really need to understand being true to label, because increasingly, and David, regulatory interest and protection of consumers is rising. And so funds that haven't put this in place, or companies or individuals who are claiming to do more than they actually do, actually face risk.
Absolutely. It's sort of there are two limbs to it, I think. Each of them comes down to doing your homework and making sure you've actually got your systems in place. So as a trustee of a workplace savings scheme, of actually, challenging, whether it's through your investment consultants or your fund managers they're exposed to, of actually make sure you fully understand what the ESG approach is of the underlying investments, and Make sure that you're not being hoodwinked by greenwashing from those you are having an investment exposure to, but then from your own perspective, what you are disclosing to the market, to your members, is make sure that you are walking the talk, that you can substantiate any claims you are making about your approach to ESG. And you can be pretty confident this is very squarely on FMA's radar. It all comes down to, are we misleading, misrepresenting the nature of your scheme's investments? Even within a workplace savings scheme, that stuff equally applies to you, and making sure that what you're saying makes sense. Go back to my early comments about look at your SIPO, make sure that what you are portraying to the market actually is backed up of what you have in your SIPO. One of the question that's come through, I saw on the Q&A, is the importance of a stewardship code, of suggesting, should we be having a stewardship code for New Zealand? I was interested in, Komal, perhaps your international experience of stewardship codes in Australia or other jurisdictions. What your view is of codes, without putting you on the spot. I know we haven't rehearsed this question, but just an interesting observation. But share any thoughts you may have.
Yeah, absolutely. So we've got the UK Stewardship Code, and look, what we end up achieving is really that level playing field, but also that common understanding for how do we think about stewardship? What are the sorts of disclosures that we can expect? And in turn, what are the activities that can reliably be expected across funds and companies in this, bringing together of the dialogue from a stewardship perspective. So active ownership and stewardship, that constructive dialogue between investors and investing companies is really important. And some of these codes really, flesh out how do you want to go about doing that. And so from a New Zealand perspective, it could be really important because increasingly, there is that recognition around climate and improving disclosure, and ESG is very much a feature and is on the rise for that recognition via investors, but also by stakeholders. And so again, it seeks to provide standardization and improved disclosure in those aspects, but also just make sure that people are doing that. It's a really important tool of bringing about sustainable investing and ESG integrations. It's really a good enabling tool. And so it facilitates that happening and its importance.
Right, so sort of a overarching framework that you can then feed into and sort of governs it. I think we are, let's see, and that could well be where we where things move to. It's probably going to be sort of softer coming through of that stewardship code. It's possibly somewhere where the likes of the FSC can take a bit of a lead in terms of running that. Don't want to put a further burden on Richard and the team as to what they might be doing, but obviously something that you can then feed into and look out for, and provide some of that overarching direction as to expectations. And a lot of it is just dealing with what is the social contract that superannuation scheme managers, workplace savings scheme managers, and the broader funds management industry may owe to society. Interested also in one of your slides, you did look at the World Economic Forum, the top risks, relatively recent, but presumably that will change now with what has happened in Ukraine and Russia, of sort of some different considerations of how do you see the World Economic Forum sort of reacting to that sort of thing?
So we're stepping in a more fractured world, and the other chart that I shared was the research, another piece of research with World Economic Forum, which talked about transformational investing. And so we're really talking about some very large systemic risks that can, very quickly change your macroeconomic environment in which you invest money and enjoy the sustainability of those healthy returns. And so you've got the geopolitical risk and cyber risk. And so these risks could move up and down in, the order of which one's at the top. But as investors, when you stress test your portfolios or when you think about either asset allocation or allocation across regions and in that investment activities, it's really important to be aware of all risks, including some of the systemic risks that could fall under the ESG label. And so, climate, and you can break climate down into a few environmental risks of its own. It's quite a broad term. And then we talk about social cohesion, which was one of World Economic Forum's on their list. And so we're seeing all of them become even more important. And so it's important for investors to have that on their radar when they're doing investment decisions, to have an awareness of those and how we're positioning our investments should any of those eventuate more quicker than we expect. So.
Yeah, challenging times. I am conscious of timing. We're just about at the end of our allotted span. Thanks for the person who fed through the comment about the stewardship code actually being in progress via the Centre for Sustainable Finance. So I guess something to look out for and to see how that may impact on our scheme trustees, fund manager audience thinking about that. And look, really thank you for sharing those thoughts, Komal. It's sort of fantastic to have somebody with your expertise and knowledge going through this. Was one of the key takeaways for me from your comments is actually that question of it's not about whether you should be thinking about ESG, but the flip is actually whether it's actually contrary to your duties not to incorporate some ESG considerations into the way you're going about investing. Perhaps we'll hand over to Richard for a wrap.
Thanks, Komal, and thanks, David. Hey, I've just one question that kind of was resonating as you folks were discussing. If you're a consumer, if you're an investor at the end of this line, I mean, this is a pretty complex area. I kind of wondered whether either of you had any insights on, if you're an investor today, thinking about the impact of this discussion, like what would you do? What would you think about? What decisions might you be wanting to take or make? And maybe it's an unfair question, but I just kind of thought it'd be one worth tossing at you.
It's a really easy one for me because I'd just say you want to talk to somebody like Komal, or if you're an investment consultant with the specific expertise there. The key thing you cannot do is hide under a rock and ignore these considerations. It's actually being proactive and thoughtful and actually jumping in and making sure that you are thinking about it and getting proper expert advice and guidance to help you identify in your particular dynamic what you're thinking about. But Komal, perhaps a bit more of an informed thought in response to that.
Very simple, just where I started initially, think about the impact my investments have on ESG and the impact ESG can have on my investments. And so there's a very two sides of the coin, but a neat way just to think about that.
Fantastic answer and excellent discussion. And thank you both on behalf of the audience watching and the audience that will watch, because this is going to end up on our FSC YouTube channel next week. So, folks, a big virtual round of applause for Komal Jalan and for David Ireland. We're pretty good at virtual applause in Zoom land. I might just give you a quick heads up on a couple of things coming up next week. On the 22nd, we have some of our amazing leading lawyers having a discussion about all things going on in the reg world, and hell, there is a lot coming through, as David said. Just the Russian sanctions piece that was launched yesterday, and much more beyond. And then on the 29th of March, for those in the health sector, we have a fantastic panel discussion with a number of the leading CEOs within the health insurance community, and Professor Des Gorman as well, to kind of talk about the future of New Zealand's health system. Again, a very timely and very relevant conversation, given we're living in the middle of a pandemic. And folks, with that, at 10:30 on the dot, have a wonderful weekend. Thanks, Komal, for getting up early in Sydney. So wherever you are in New Zealand, wherever you are in the world, thank you for watching, and we'll see you next week. All the best. Have a great weekend. Bye for now.